Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website marketviews.tv. How you doing today, Ike?
Good, Mike. How are you?
Oh, I'm doing great. And you sent me two interesting charts about XAU, the gold stock index. And we've had a huge run in gold over the past month. It's gone through that $1,350 barrier, but it's down a little bit today and yesterday. And in reality, though, it's been going up since August when it was at below 1,200 briefly. So this move's been taking place for quite some time, and we've seen moves over the years where gold will top out and just go straight back down. So I'm very interested to see your analysis of what's going on in the XAU.
Well, Mike, we have talked about this indicator several times over the last decade. And the last time we spoke again about it in great detail was on April 29th, or on April 25th, as a matter of fact. Now, the concept behind the indicator is this. When you look at the way cumulative volume is calculated, you take the up volume minus the down volume, and then you add that to yesterday's figure. So what that means is this. If, let's say, somebody sold 1,000 shares of a $5 stock, and somebody bought 1,000 shares of a $500 stock, the net difference is zero because you have minus 1,000 shares plus 1,000 shares. The net difference in the cumulative volume is zero. But if you look at the dollar volume of the transactions, in the first transaction we have somebody sold $5,000 worth of stocks, and in the other one somebody bought $500,000 worth of stocks. Well, I don't think the two have the same significance as the volume alone would indicate. That's my belief. So what I have done is that I have devised an indicator that actually takes into consideration the dollar volume of the up and down volume of the stocks that make up an index. Now, in this particular case, the two charts that we have discussed many times before, these are the 25 and the 50-day daily moving average of the cash inflows and outflows into the XAU stock components. Now, we have shown the same indicator for the OEX and the S&P 500 and the Dow in the past. Now, the black line represents inflows, okay, and the red line represents outflows. The 50% is when we have equilibrium. So when we can have either a positive crossover, like the inflows exceed 50%, or a negative crossover, or like the outflows, the sales, so to speak, exceed 50%. Okay. Now, to understand how this can be helpful, I would like to discuss, and we have mentioned this before, but for the benefit of our listeners, I'll mention it again, what this indicator is designed to do and what it is not designed to do. So let me start with what it is not designed to do. It is not designed to give you an entry and exit signal based on a positive or a negative crossover, okay? Like when you have a crossover like we had a few days ago, I have not designed it to be a signal to buy or to sell. Okay. The next thing that it is not designed to do, and actually no indicator that has ever been designed which measures which measures internals can do, is predict the change in the internals. I'll give you an example. Let's say on Saturday, we get an announcement that there is a US-China trade deal that is actually the best US could hope for. China gave up everything, okay? In that case, there's no more talk about rate cuts. The dollar reverts to the upside and gold takes a hit.
Okay.
Take it. That cannot be predicted, okay? The conclusions that we draw are under the assumption that what we see will continue until it changes, okay? So now, let's talk about what the indicator is designed to do. What the indicator is designed to do is to confirm the ongoing trend. If the price trend is up and we have a positive crossover, that means we have also sponsorship. It confirms the bullish trend. In a bullish trend, what do? You buy pullbacks.
Mm-hmm.
Okay? So when I have a crossover, that tells me to look for a pullback to buy. Okay. The second thing that it does is it gives you an alert through positive or negative divergences. If price is going up, but this indicator is going down, that tells me the trend is not sustainable.
Okay.
Alert. And the third thing that it does is through the method of extrapolation, you can calculate at which point you may have a price reversal. For example, if the price is going up, but the indicator is going down, then you can extrapolate at which point you're going to have a negative crossover. At that point, selling pressure exceeds buying pressure, and you're going to have a reversal in price. Using this method, if you recall, and I hope our listeners recall, we had an interview on January 15th of 2018, and at that time I said we were looking for a top in the S&P between 2875 and 2905. Well, the S&P topped on January 26th, 11 days later at 2872. Just 2 months ago, on April 25th, we did an interview, and at the time, if you recall, I said we are looking for a reversal at about 3010 in the S&P, plus or minus 1.5 percentage points. So the zone we were looking for a reversal was between 2950 and 3050. Well, the market topped out at 2954 on May 9th.
Mm.
So that is another thing that this indicator can do, is through the extrapolation method, give you a zone that you can expect a reversal, either to the upside or the downside. So now let's put it all together. The fact that we have had positive crossovers, that tells me that there is sponsorship. There's money coming into gold stocks, and the bullish trend has been confirmed. In that case, what do? I buy pullback. Just like if we had the confirmation of a bearish trend, I would sell rallies. In this case, I buy pullbacks. To be more specific, in the XAU, I told my subscribers early in the week, the area I would look for the first pullback would be around 80, to be around 85 in the XAU, and the first pullback should end around 78. So what I would do if I'm an intermediate term buyer, I would look to buy around 78 with a stop around 76, 75. Okay? Now, to take it further, again, using the extrapolation method, if these trends continue, the upside target should be around 90, 95, and maybe as high as 100. One thing I cannot predict if, as I said, tomorrow or next week something happens and all this changes. If it continues, the upside target is between 1995 and as high as 100. So I would look to buy, as I said, around 78 with a stop around 76, 75. That depends upon the risk tolerance of each investor. The bottom line is the uptrending price is confirmed. The bullish trend is confirmed. In a bullish trend, you buy pullbacks until it changes. And at this point, there is no change, there is no evidence that it has changed. There's only the evidence that we have confirmation.
So then in sum, the breakout has basically been confirmed and we're in a rally and, you know, we can think or expect the trend is up. So buy the dips.
Yeah, if it continues, you have an upside target between 90 and 95 and as high as 100.
Well, in that case, let me ask you this. Okay, assuming gold, we can look at upside targets. Why even mess with it? Because other things can go up too. Bitcoin, we've just seen a huge move, but bonds have gone up a lot. Probably go up more. Stock market is doing well. So why even mess with gold?
Well, look, each person or each investor, let's say, could have different reasons for buying something. Somebody could buy something like Bitcoin simply because it is going up. Personally, I don't buy things just because they go up. I buy things because technically they're in a bullish trend and fundamentally there is something that backs up the technical trend. So I'll tell you my reasons for buying and wanting to own gold. It doesn't mean that my reasons are applicable to everybody else or everybody else should agree with me. But I'll tell you my reasons. One is this. Right now, we have $13 trillion in government bonds that have negative yield. Now, I want to ask you a question. Lending $100 to someone, so a few years later, you can get less than $100 back. Is it a viable economic proposition to you?
It doesn't make sense to me, but...
Would you give me $100 if I guarantee you that you'll get 98 in 5 years? Why would you do that?
Well,
it makes no sense.
No.
Okay. Let me give you a second. My point is the interference in the free market by central banks may not have come to its end, and maybe we have another 1 or 2 or 3 years to go, but common sense tells me this is not viable. So I don't think it's going to end up well. I don't believe it's going to end up well, and I want to have some security, and that comes in the form of gold. Another reason is this. When you look at gold versus other asset classes, gold has a tendency to do very well when valuations between gold and equities are depressed. Like, for example, when the ratio between gold and the S&P is low, and inflation is rising.
Okay.
Conversely, gold has a tendency to do really bad when valuations are high and inflation is falling. If you look at the ratio between gold and the S&P right now is 0.5. In 2000, it was at 0.2. In 2011, it was at 1.5. So right now, we are below the midpoint, okay? And when it comes to inflation, if you believe the ECRI's research, which I do, is that from an inflation standpoint, we are in a downtrend, we're in a negative cycle. But that won't last forever, given that we have full employment.
Mm-hmm.
So my point is, in the next few years, okay, we should see a rising inflation, and at the same time, valuation of gold compared to the S&P is about, as I said, below the midpoint. So if I'm willing to hold gold, more than likely, 1 or 2 or even 3 years from now, the chances are I will have better returns than if I own some other asset class like bonds or equities. So these are my two reasons for wanting to own gold. Now, how much of it? Again, my own personal preference, is anywhere from 10 to 25, 30%. But I gotta tell you, if I'm having 30% of gold in my portfolio, gold and gold stocks, then that means the other 70 is in cash.
Well, that makes sense to me, and you know, that's how I think people need to look at it. That's how I look at it. It's part of an overall investment strategy. That's, uh, and I think that type of thinking or managing your money is going to be more important going forward than ever before.
Well, think about something else, Mike. Look, right now in the U.S., with unemployment at 50-year low and GDP growth at about 2%, we are running $1 trillion deficits per year. This is the same amount of deficit that we had at the depths of the recession in 2009. My question is this: if with good economic growth we're running deficits of $1 trillion per year, what kind of deficit are we going to run if we have a recession? Second question: will foreigners be willing to finance our deficit, or will foreigners be willing to finance $2 and $3 trillion deficits by buying U.S. securities? That I do not know. I have my doubts, and that is why I want to have some gold.
Yeah, definitely, and that's a situation that could explode overnight when it does.
Yeah. And as I said, that I have my reasons. I just explained to them. I just explain them. It doesn't mean that they should be accepted by everybody. But I mean, these are my reasons, and I believe they're good ones.
Well, I agree with you 100%, and it'll be interesting to see how this plays out the rest of this year and beyond. And your money flow indicators are an interesting guide going forward. I'd note, the 50-day moving average, it had a negative crossover a year ago in the summer before the XAU fell that August, and it warned,
Yes, yeah, exactly.
and warned that, look, there was a bounce right before that August breakdown, and the money flow indicator warned that bounce was
Was going to fail, yes.
was going to fail, and now these indicators are acting the complete opposite. So
That's
that's
the point. Yeah, Mike, that's exactly the point, okay? Which indicate a change in the environment.
and we got, as you explained, the macro situation is much different too than it was 12 months ago. So really interesting times, and glad we'll be able to witness them together going forward.
Certainly.
And thanks for talking to me and my people out there in YouTube land. And I recommend to go to marketviews.tv. I'm a paid subscriber of the private material inside the website, and look at the updates quite frequently. So thanks, Ike, and we'll talk again soon.
Thank you, Mike. Good talking to you too.